The stock of the day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
And our stock of the day is Xero, the accounting software platform, saying after-tax profit rose 42% for the first half of the financial year to 135 million Kiwi dollars. Half-year revenue rose 20% to 1.2 billion. As the software firm delivered another strong result, it says it demonstrated strong momentum with its portfolio of large markets and products, but operating income fell 22% as a result of costs related to its buyout of bill-paying service Melio in the States. So let's get to the analysis, and as you can see, that was negatively received. Currently off by around 5.5%. Howard, what do you think?
Yeah, I mean, I used to joke that it was appropriately named Xero because it made zero profits. But the last 2 years, it's actually been making profits. It took about 15 years to get there, but it's actually making profits. Problem, though, is it's on a PE, or at least it was before today, of about 103. And no company has ever maintained a PE of over 100 long term. It's never happened. So when PEs get up into those stratospheric numbers, you know they're not going to stay there. So it is now making profits. It does therefore look better than it looked before, but it's only had 2 years worth of profits. So from a Teaminvest perspective, we don't have enough data to make any kind of confident predictions about it. So Teaminvest members would say, can't discuss this, no point, let's move on and use our time more productively on something else. But it is at least heading in the right direction. So a no from me, but not the kind of a no it used to be until a couple of years ago, when it was a much stronger no.
Okay, an unenthusiastic no.
It's an unenthusiastic no now.
Okay, Kai.
Xero is very interesting because, like as Howard mentioned with the PE, it looks insane because it's over 100. But as a lot of tech companies, if we looked at Palantir, if we look at a lot of these tech companies, their PE ratio is so skewed because their pricing is so much forward growth and expectation, right? So I think the first thing to address is why is the price down when their earnings have been pretty good? Again, it's expectations. So their EPS actually missed by about, earnings per share, missed consensus by about 13%. So the market was expecting a lot more than what it delivered, right? So even though on headline figure looks great. Now, in terms of where the value zone is for us, and you know, I think on a longer term basis, you can make the argument whether it's either one or the other, whether they start making more revenue and the PE goes down because the revenue and profitability actually increases. You get that lower number, or the other way around where the price corrects and it's actually not worth this much. But it's a massive company. Everyone uses it. It's probably the most used accounting software. So I think its addressable market is massive. For us, where it's value, we're looking at about $120. If it gets down there, or even now, at $130. It's interesting for us. So it's definitely something we're looking at.
So not a buy.
Oh, in the buy range. I'll be a bit more.
You are putting a buy on it.
I'll put a buy.
Okay, given where it's fallen to.
I'll put a buy. Yeah.
Okay. Well, that is a buy and a no for our stock of the day, Xero.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at IG.com.